Brent rose to about $119. WTI only moved near 100. And the gap between them widened to roughly $12, around an 11-year extreme. That should not happen if this were just one simple war trade. So why did the same escalation produce two very different oil prices? Brent is closer to the world market for oil moved by sea. WTI is a major benchmark too, but it sits more inside the North American system, with more insulation from inland U.S. supply. So when fear rises around Gulf export assets, globally traded crude usually feels it first. That is Brent. And that is why the split mattered. The same escalation that pushed Brent toward 119 only took WTI briefly to about 100. The gap itself was telling you this was not just about oil getting a little more expensive. The market was putting a much bigger premium on barrels tied to the world market and Gulf risk. The deeper problem was this. The war did not just stay inside a normal exchange of strikes. The reported escalation around March 18th and 19 appeared to move closer to the Gulf energy system itself. South Pars and Asaluyeh came into focus. Risk was no longer just about military retaliation in the abstract. It was about major energy sites. And once that happened, Brent started to make more sense, because Brent reacts more directly when traders think seaborne, crude, export terminals, and nearby energy routes may face disruption. WTI can still rise on the same headline, of course. But if the fear is centered on globally exposed Gulf supply, Brent usually moves harder. So the first layer of the answer is this. Brent heard a different kind of alarm, but that was only the first clue. The deeper problem was that traders were not just looking at oil wells or tanker headlines. They were looking at a connected Gulf energy zone. South Pars matters here not because this is an LNG deep dive, but because it sits inside one of the most important gas and energy areas in the region. Asaluyeh matters because it is part of that same export and processing picture. Then you add risk around Qatar's Laffan, one of the most important LNG hubs in the world, plus concern around Saudi and Kuwaiti facilities. That changed the picture. This no longer looked like one country losing a few barrels for a few days. It started to look like traders asking a harder question. What if the conflict is broadening into repeated threats against the Gulf's energy system itself? That is a very different market problem. Because once traders start thinking that way, they are no longer pricing only immediate oil losses. They are pricing outage duration. They are pricing precautionary shutdowns. They are pricing the risk that operators, shippers, or governments act more carefully around critical sites. And they are pricing the chance that damage or threats spread across oil, gas, LNG, and export facilities at the same time. In other words, the fear widened. And that is where the Brent versus WTI gap becomes so useful. If this were mainly a US-centered supply issue, WTI would likely tell more of the story. But when the premium opens up on Brent, that is a strong sign the market is focusing on globally exposed barrels. It is saying the world market side of energy supply looks more vulnerable than inland US crude. That is what made this move different. And there was another clue supporting that red. European gas also moved higher in the same window. That matters because it suggests the fear was not trapped inside oil alone. Gas and LNG risk were also entering the picture. Why does that matter for oil pricing? Because energy markets bleed into each other when the same region anchors multiple supply chains. If traders start worrying about South Pars, Asaluyeh, Ras Laffan, and nearby Gulf assets at the same time, they are not just asking how many oil barrels might disappear tomorrow, they are asking how much stress could hit the wider energy export system. If gas flows come into question, buyers may scramble for alternatives. If LNG risk rises, power markets and fuel substitution fears can spread. If export reliability starts to look weaker, the premium on replacement barrels rises too. And replacement is the key word here. The market was not only asking, can some supply be lost? It was also asking, how easily can the world replace what the Gulf normally provides if the threat keeps widening? That is where spare capacity, export flexibility, and delivery confidence all matter. Not because every site was offline, but because the market suddenly had to think about a much bigger zone of vulnerability. So the basic point was simple. Brent moved harder because traders were paying up for oil that is exposed to the global seaborne market at the exact moment the Gulf energy system looked less secure. WTI still rose because war risk lifts oil broadly, but WTI did not carry the same premium because it is not the same thing. It is more buffered by North American inland dynamics. Brent is where the global fear showed up first and hardest, and that is why the spread near $12 mattered so much. It was not just a statistic, it was a message. It said traders were no longer treating this as a routine war spike. They were treating it as a wider Gulf energy scare with consequences across oil, gas, LNG, and export reliability. For ordinary people, that can move quickly from a market chart into real costs. If Brent stays under a heavier war premium, fuel prices can rise more broadly. Airlines face higher jet fuel pressure. Freight gets more expensive. Delivered goods can cost more. Gas and utility worries can build if LNG fear stays elevated. And if all of that lasts long enough, inflation pressure gets another push at a time when many households are already stretched. That does not mean every spike becomes a lasting shock. Some war premiums fade fast. Some spreads close back down once the fear cools. But this move got attention for a reason. The benchmark behavior was telling you the market thought the risk had widened beyond the usual headline reaction. So when people ask why crude suddenly hit $119, the best answer is not just that war broke out. The better answer is that Brent broke away from WTI because traders were suddenly pricing the chance of a wider Gulf energy infrastructure war. That included risk around South Pars and Asaluyeh, concern around Laffan, and broader fear that Saudi, Kuwaiti, and nearby export assets could be pulled into a regional energy scare. Once that possibility entered the market, globally exposed crude had to carry a much larger premium, and that is the mental model to keep. When oil jumps on war news, do not just look at the headline price. Look at which benchmark is moving harder. If Brent is pulling sharply away from WTI, the market may be telling you something more specific and more dangerous. Not just that war risk is up, but that the world-facing part of the Gulf energy system itself is being repriced. That was the real signal inside the $119 spike.